If you think your pension will protect you in retirement, you've already lost. Your money is shrinking in value every single year. The system you trust to safeguard it is quietly taking a cut. Your pension, your savings, even your so-called safe investments are part of a game designed for you to lose. And the people running that game are playing with a rulebook you don't even get to read. Most Americans spend decades believing the promise, work hard, contribute to your pension, and you'll retire comfortably. But pensions are no longer the safety net they were meant to be. The money you've been setting aside is often invested into vehicles that carry more risk than you're told. Management fees eat away at your returns year after year. Some pension funds are underfunded by billions of dollars. Others are managed so poorly that they depend on unrealistic investment returns just to survive. When those returns don't happen, the shortfall gets covered by taxpayers or, worse, by cutting benefits to retirees. Imagine working 30 years as a teacher or firefighter, only to discover the pension you were promised is slashed by 20% or more. This isn't an isolated problem. It's happening across the country, and it's happening legally. Financial planners, fund managers, and even entire unions work with large banks to manage these funds. They're paid whether your account grows or shrinks. You take the risk, they collect the fees, they sell you the idea that bonds and other traditional assets are safe. But safe in today's market often means slow erosion of your wealth. Pensions were once backed by predictable investments and a stable currency. Today, the currency itself is losing value. That means even if your pension grows on paper, what you can actually buy with that money keeps shrinking. If you think your pension alone will carry you through retirement, you're leaving your future in the hands of people whose main goal is to keep you in the dark. The first step to breaking free is to understand what you're really dealing with. America's #1 export is not cars. It's not technology. It's not even oil. It's fake money. The United States creates money out of thin air and pushes it into the global economy. To create this money, the government first issues bonds. These bonds are essentially IOUs, promising to pay back with interest in the future. Investors, including pension funds, buy these bonds believing they are safe. Once the bonds exist, the Federal Reserve and the Treasury can create new dollars against them. Trillions are added to the system every year. Every new dollar reduces the value of the dollars already in circulation. This is inflation in action. If you had $100 in 1990, it could buy a week's worth of groceries for a family. Today, that same $100 might only cover a few bags. Your savings, if kept in cash or fixed income investments, lose purchasing power every year. When inflation rises faster than your returns, you are going backward even if your account balance looks bigger. Financial planners still recommend bonds and similar assets as safe. They may not crash like stocks in a single day, but they quietly drain your wealth over time. Saving money in a system that keeps printing more of it is like trying to fill a bucket with a hole in the bottom. You work harder to pour more in, but it never stays full. This is why relying on cash and bonds as your main store of wealth is financial quicksand. If the currency itself is unstable, no fixed income product can truly protect you. The sooner you understand this, the sooner you can start protecting your future. Is this conversation helpful so far? For decades, investors have been told that certain investments are safe. Bonds, mutual funds, and diversified stock portfolios are sold as reliable long-term choices. Financial planners present charts showing steady growth over decades. They talk about average annual returns and market stability. What they leave out is how much volatility and loss can happen along the way. A portfolio that averages 6% a year over 30 years can still experience multiple 30% drops in value during that period. For someone close to retirement, a single downturn can erase years of gains. In 2008, millions of people watched their retirement accounts lose nearly half their value in a matter of months. Many were forced to delay retirement or return to work. These so-called safe investments are also deeply tied to the same financial system that prints money and fuels inflation. When inflation rises, the real return on bonds and fixed income products can turn negative. Even stocks, which tend to outpace inflation over the long term, can go through entire decades of stagnant or declining returns. And while your money is trapped in these funds, management fees keep draining a percentage every year. These fees might seem small, but over decades they can remove hundreds of thousands of dollars from your potential gains. The word safe in the financial industry often means safe for the institution, not for you. It means the bank, fund manager, or financial advisor gets paid no matter what happens to your account. If you put your trust in the idea of safe investments without questioning the reality, you give away control of your financial future. Control, not comfort, should be your priority if you want lasting wealth. Here are two financial paths: the rat race and the fast track. The rat race is the cycle most people live in. Work for a paycheck, pay taxes, cover bills, save a little, hope it's enough for retirement. It's a system designed to keep you dependent on your job and on the institutions that manage your money. The fast track is different. It's about building assets that generate income whether you work or not. It's about controlling where your money goes and how it grows. Instead of putting your savings into funds managed by strangers, you acquire assets you can directly influence. This could mean owning rental properties that produce monthly cash flow. It could mean buying a share in a private business that pays you dividends. It could mean building your own business that runs without your daily involvement. The fast track requires you to think like an owner, not an employee. You stop relying on a single source of income. You focus on assets that grow in value while also paying you regularly. Real wealth is not measured by how much you earn from a job. It's measured by how many months or years you could live without needing that job at all. The rat race keeps you running in circles. The fast track moves you toward financial independence. The choice between the two starts with where you decide to put your time, effort, and capital. Some assets keep their value even when currencies weaken. Gold and silver have been trusted stores of wealth for thousands of years. They are physical, finite, and cannot be printed by governments. When inflation rises, these metals often increase in price as investors seek safety. They don't produce income, but they can preserve purchasing power over time. Cryptocurrencies like Bitcoin and Ethereum are newer, but share a key feature with precious metals. They have limited supply. Bitcoin is capped at 21 million coins. This scarcity is part of what gives it value. Unlike gold, crypto can be transferred instantly across the world. Its price can be volatile, but for many it represents an escape from the traditional banking system. Holding a mix of real assets can provide a hedge against inflation and currency decline. An ounce of gold in the year 2000 was worth around $280. Today it's worth over 10 times that amount. Bitcoin was worth under $1 in its early years. Today, even after large price swings, it remains thousands of times higher than its launch price. Real assets are not risk-free. Their value can drop, sometimes sharply. But they are not dependent on a government's promise to repay debt. They are not tied to a currency that can be devalued at will. A portion of your wealth in assets like these can act as insurance against the failure of the system you've been told to trust. Most people never learn about money in school. They graduate knowing how to solve math problems but not how to manage their own income. They can write essays but not a personal budget. This is not an accident. The education system was built to produce employees, not owners. It teaches you how to work for money, not how to make money work for you. Financial education has to be self-taught. It comes from books, courses, mentors, and real-world experience. It comes from studying taxes, investments, and business systems. It comes from learning how to evaluate risk and spot opportunities. The right knowledge can change the direction of your life faster than decades of hard work in the wrong system. If you understand how taxes work, you can legally keep more of what you earn. If you understand how to analyze an investment, you can avoid deals that look good on the surface, but drain your money over time. If you understand how to build cash flow, you can create income streams that continue for years without your daily effort. Financial literacy is not just about numbers, it's about control. Without it, you will always be dependent on the advice and decisions of others. With it, you can build a future that doesn't depend on luck, pensions, or the promises of financial planners. Take control of your financial future by starting with a clear picture of where you are now. List every asset you own. List every debt you owe. Identify how much of your current wealth depends on pensions, retirement accounts, or traditional savings. If most of it is in assets that lose value to inflation, you need to rebalance. Move a portion into real assets that hold or grow their purchasing power. This could mean buying physical gold or silver. It could mean starting a small position in Bitcoin or Ethereum. It could mean acquiring rental property in a stable market. Set aside a separate account for your Freedom Fund. This is money dedicated to building income-producing assets, not covering daily expenses. Decide on a fixed monthly contribution and treat it like a bill that must be paid. Automate it so the money moves before you have a chance to spend it. Keep learning. Read one new book on money each month. Follow investors and entrepreneurs who share proven strategies. Take a small amount of capital and practice making investments on a scale where mistakes won't ruin you. If you save and invest $500 a month in assets that grow at an average of 8% a year, in 20 years, you could have over $290,000. If you increase that to $1,000 a month, you could reach nearly $600,000. The earlier you start, the more time works in your favor. Waiting even 5 years can mean hundreds of thousands less by the time you retire. Every investor faces risk. Even the best decisions can lead to losses. Markets change, businesses fail, unexpected events can wipe out value overnight. The key is not to avoid risk completely, but to manage it. Spread your investments across different asset classes. Don't put all your money into a single stock, property, or currency. Have a plan for what you will do if an investment drops in value. Decide in advance the price or condition where you will sell. Never invest money you cannot afford to lose. Use smaller amounts to test new strategies before committing more capital. Learn from losses instead of ignoring them. Each mistake teaches you what to watch for next time. Some of the most successful investors built their wealth after failures that could have ended their careers. They recovered because they kept enough reserves to stay in the game. Your biggest loss is not money, it's time. Money can be earned back, time cannot. The sooner you take control of your investments, the more options you will have. The longer you wait, the harder it becomes to recover from setbacks. In the next 30 days, you can take steps that move you closer to financial independence. Start by moving a small percentage of your savings into assets that can beat inflation. This might be a purchase of physical gold or silver. It might be opening an account on a trusted cryptocurrency platform and making your first buy. It could be putting a down payment on a rental property or buying shares in a real estate investment trust. Set up a dedicated account for your Freedom Fund if you don't already have one. Make your first contribution immediately, no matter the amount. Review your current debts and create a plan to eliminate the ones with the highest interest rates. Cut at least one unnecessary recurring expense and redirect that money towards your Freedom Fund. Pick one area of financial knowledge to focus on this month. This could be learning about tax strategies, real estate analysis, or dividend investing. Find a reputable book or course and commit to finishing it. Identify one person in your network who is financially ahead of you and ask to learn from their experience. Avoid the temptation to overhaul everything at once. Small, consistent steps create lasting change. Every month you delay is another month the system collects from you. The earlier you act, the more control you have over the outcome. The system is designed for you to lose. It rewards those who control assets and penalizes those who only earn wages. Pensions, savings accounts, and so-called safe investments keep you tied to a cycle you didn't create. You have the option to step out of that cycle. You can build a portfolio that grows without relying on government promises or the stability of a single currency. You can own assets that pay you whether you work or not. You can protect your wealth from inflation and market crashes, but it requires action. It requires learning skills that schools never teach. It requires taking responsibility for every dollar you earn, save, and invest. You don't need to be a financial expert to start, you just need to start. Every small move toward control adds up over time. Every dollar you shift into an asset you understand is a step toward independence. Every month you choose to learn instead of ignore is a month you move ahead of the average. On the passive path, the goal is simple. Take control of your money. Build assets that work for you. Stop relying on systems that work against you. If this message helps you see the game more clearly, share it with someone else who needs to hear it. Like this video. Subscribe for more strategies that keep you moving toward financial freedom. Leave a comment about the step you plan to take next. Your future is not decided by chance, it's decided by choice. Make the choice today.